Hey everyone, it's Tracy here. In today's video, I want to talk about a little bit about the stock market cycles. I also want to talk about the early signs of recession because I believe by just understanding this, you're going to be better prepared. And most importantly, I want to talk about the steps you can take if we hit a recession in Canada. So let's nerd it up and do a history lesson on the stock market cycles. So typically every stock market has its traditional stock market cycle. So in the early cycle phase, the economy is coming back from some type of bad event like recession or like what we experienced during early 2020. And at that time, the credit markets are going to start lowering interest rates to stimulate the economy. And of course, cheap money is like flying around. Also at that time, corporate earnings from all the companies are growing. And because there's lowering interest rates, the economy is getting back to normal, well, people spend more. And of course, the companies make more money. That's why earnings grow during this time. Now, typically in an early stock market cycle, many sectors will do well, including materials, technology stocks, real estate, financials, and the stocks that actually underperform are the safer value stocks like the utilities, energy stocks, healthcare. Great litmus test to know if we're in an early stock market cycle is when hyper growth stocks do really well. The next phase is the mid-cycle phase, and at this time it tends to be the longest of the cycles where the economy is getting stronger, interest rates are at their lowest, and corporate earnings are also at their very strongest. But growth is probably going to slow down relative to the early stock market cycle because we just recovered from a very traumatic event. So at this time, the best sectors include technology stocks, basic materials, industrials, and as interest rates starts moderating or starts to rise, well, the government starts, interfering in trying to fight inflation, which is kind of like what we experienced last year. And a great litmus test is that during this time, technology stocks tend to do super well, including communication services. Hey everyone, I just want to take a brief pause and introduce you my free resource, which is the ultimate guide to dividend growth investing. If you are preparing for recession, or you just want to diversify your stock portfolio so that you can survive and thrive in any stock market cycle, then I really recommend you download this guide, which is to help you become a knowledgeable investor, investing in boring stocks like the utilities, financials, this type of companies that we have a lot in Canada that pays you money every single month or every single quarter, every single year, so that you can create a lifetime of passive income. And we have a lot of these in Canada. So check out in the links below my ultimate guide to dividend growth investing. Plus, it's free. So let's get back to the video. Now, in a late stock market cycle, growth is going to probably slow down, okay? We're going to look like we're overheated. Stock prices are going to look really high relative to what they're earning. And inflation is probably going to run a little bit rampant. At this time, the government really interferes and tries to fight inflation and raises interest rates. Does that seem pretty familiar right now? And during this phase, the best sectors to invest in are energy, utilities, healthcare, and consumer staples. And this can become really important when it comes to the Canadian stock market. And a great litmus test is that you're going to recognize your healthcare and your energy stocks are outperforming in the stock market. Now, during recession, the economy, of course, is slowing down. In fact, technically, we need 2 consecutive quarters where the economy is slowing down to actually show signs of inflation. And during this period, well, corporate profits are starting to fall. The stock market may also enter a major correction, and interest rates are at peak levels. Now, in a typical stock market cycle, recession is usually the shortest cycle of all the periods, okay? Typically, they last less than a year, except, during COVID. And we can quickly actually jump into an early stock market rebound. And typically, the stocks that do really well during recession are consumer staples, which makes sense because we need to still buy stuff like from Costco, Walmart, Target. We also need healthcare, which is why the healthcare sector still tends to do well. And we still need to pay for utilities, which is why utilities, healthcare, and consumer staples outperform during recession. So a great litmus test is when your utilities look like your best stocks in your entire portfolio. Now, Just because we have all these phases in the stock market doesn't mean we enter each phase. In fact, in a stock market cycle, we could just skip out the recession period and flip right straight back to an early stock market cycle. So it's not saying recession is guaranteed. It's just saying that it is common that we do enter a recession. It's just that if we do enter a recession, it's usually very, very brief, often less than a year. So what are the signs of recession in Canada? So if we enter recession, we got to look for 2 consecutive quarters where our economy is slowing down. We also need to look for rising inflation year over year. And well, what the government is going to do is start raising interest rates really aggressively, which kind of seems like it is happening right now, but relatively speaking, compared to the past couple decades, our interest rates are still ultimately low. And because the Canadian economy and same the US economy has incurred a lot of debt, I really don't think interest rates are going to really rise too much because they're really shooting themselves in the foot. Now, if you're trying to prepare yourself for recession and want to know if we're likely to hit recession, here's 3 indicators that you might want to track. The first one is the most obvious one, is unemployment. Obviously, when the economy is not doing well, then a great indicator to know that is if we had high unemployment. Like we're talking about, say, the financial crisis, or maybe during the last crash in early March when, basically the economy shut down and there were no jobs available. That's a time where there's a high likelihood that we're going to hit recession. The next indicator that I look for, which I'm sure a lot of you are very, very familiar with, is the gross domestic product. What that is that if technically to hit recession, we need 2 consecutive quarters where the economy is slowing down. And what they're going to look out for is the gross domestic product. So this is a great barometer to see if the economy is, expanding or falling. Next thing I'll look for is the yield, okay, the yield curve. Now what this means, the yield is actually just AKA the interest rate on a bond, the treasury bond, okay, the 10-year treasury bond. And what happens that, like as an investor, if you are looking to diversify your stocks and hold bonds, you are probably going to want a higher interest rate for, say, a 10-year bond, because you're going to have to hold out for 10 years and a lot more can go wrong than, say, holding a bond for 3 months. So if you want to hold a 10-year bond, you're going to command a higher interest rates, a higher yield than, say, a 3-month bond. Now, what the inverted yield means is that when this changes, when all of a sudden investors are looking at, hey, the next 3 months is going to be way scarier and I'm going to want higher yield, a higher interest rate in my 3-month bond than a 10-year bond. And when that happens, that's what's called an inverted yield. Now, economists and strategists really take a close look at the yield curve, because if it's inverted, if the past has someone predicted the future in the past 50 years, an inverted yield curve between the 3-month interest rates of the treasury bond and the 10-year yield of the, aka interest rates of a bond, if they are inverted, this has always been an early indicator of recession. So what does this mean for the Canadian stock market? So I would say look for those 3 indicators, which is the inverted yield, rising high unemployment, and of course a slowing economy for 2 consecutive quarters. And that if you see that, then of course we officially hit recession. I would say none of us can predict the future. We never know if we're going to hit recession because, anything can happen in the future. But I think the best thing we could do is prepare for it. And so here are the steps that you can take to prepare yourself if a recession hits the Canadian market. So we're so lucky that in Canada, we have a lot of dividend growth stocks, which are types of boring companies in the utilities, financials, and in the energy sector that still makes money because we always have to pay for fuel, we always have to pay for utilities, and so on. So with those type of companies, please look for companies that always have growing revenue, growing earnings, low payout ratios, and growing cash flow, and then you're covered. These are high quality companies, and we have a lot of them in Canada. And if recession hits and every stock takes a haircut, then at least you're collecting dividends to protect yourself during a downturn. Now, another thing you could do in preparation for recession while you're balancing your portfolio is trim off the companies that have super, super high PE ratios. Now, you probably already know what type of companies have those super high PE ratios. What that means is that the stock price relative to the company's earnings, well, it's really, really expensive relative to how much they're making. It's like, I always use the example of a price per pound of cherries. Okay, now if it ever goes up and skyrockets to $9.99 for a pound of cherries, obviously I'm going to avoid buying those cherries. So that's the same thing with stocks. And so those type of stocks are going to be the speculative stocks or the early stage companies that are just starting to become profitable, but they're not quite profitable to the point where they're making a ton of money. So their stock price is going to look expensive compared to what they're making. Now, another thing you do in preparation for recession is have a lot of dry powder. I know I've been saying in my past videos that cash is trash. It's not necessarily true. In fact, it's always good to have a big chunk of money saved on the side just in case for emergencies or where there's amazing opportunities in the stock market, because it's during these times when everything looks like it's falling and people are super scared where there's the biggest opportunities in the stock market. So please avoid margin, have cash on the side so you can jump into the opportunities. And then if you do see an opportunity, don't just deploy all your money. Just keep buying it as it goes down. I know it probably will be scary, especially if you're a new investor, but that's, again, the greatest opportunities is when you could buy high quality companies that have dropped because the rest of the stock market has dropped, but it's nothing to do with the company. So essentially, I'm trying to say is ladder in with your position. So if you have $30,000 to ladder into a stock, don't deploy all 30K into that stock. Ladder in. Maybe you want to deploy 10K the first time. And the second time, if it drops even more, then plunk in your next 10K. And then if it drops even more, well, then drop in your last 10K. So basically it's dollar cost averaging as it's going down because, well, it's considered undervalued according to your standards. Anyways, I hope you found this video super helpful. All I ask of you is give me a thumbs up.